Hello friends, I am Professor Abdul Kadir Arsiwala and today we will be solving a problem on accounting for buyback of equity shares. So first of all, let us look at the problem. Anu Limited, a non-listed company, furnishes a following summarized balance sheet for 31st March. Share capital contains 12% redeemable preference shares of rupees 100 for 75 crores and equity shares of rupees 10 each for 25 crores. All the figures are in crores. Besides that, reserves and surpluses contain a capital reserve of 15 crores, securities premium of 25 crores, revenue reserves of 260 crores, making up a total of 300 crores, and the liability side of balance sheet comes to 400 crores. At the asset side, we see fixed assets at 100 crores less depreciation 100, so fixed assets are at 0. Non-current investments at 100 crores and current assets at 300 crores. The company has redeemed preference shares on 1st of April 2000. It also bought back 50 lakh equity shares of rupees 10 each at 50 per share. Okay, so they bought back 50 lakh shares at 50 per share. Okay, the face value of the share was rupees 10, but they bought them back for 50. So premium per share comes to 40 rupees. The payment for the above means the redemption of preference shares and the buyback of equity shares. The payment for the above was made out of huge bank balances which appeared as a part of current assets. Now what we have to do is we have to pass journal entries to record the above transactions. Okay, so we will pass journal entries. For that, first of all, let us make the journal should look like this. In the books of Anu Limited, journal entries. Once this format is prepared, now we can start with this sum. Now what happens first? Let us look at that. What happens first? We are redeeming the preference shares. Okay, so we will go according to the sequence of the sum. We are redeeming the preference share, so I will pass the entry for redemption of preference shares. We have redeemed entire preference shares, 75 crores entire preference shares we have redeemed, so the entry for that will be preference share capital account debit, preference share capital account debit to preference share holders account. Preference share capital account debit to preference share holders account. The amount is rupees 75 crores. Entire amount we have redeemed, so I'll write 75 crores here and 75 crores here. The entry I will pass, being preference share capital transferred to preference share holders, being preference share capital transferred to preference share holders, preference share holders. Now this was the first entry. We have transferred the preference share capital. Now we will need to make payment to the preference share holders. So the entry for making payment will be preference shareholders account debit. This account will be debited and we will be making them payment, preference shareholders account debit to bank account 75 crores. Okay, again the narration for this will be payment made to preference shareholders, payment made to preference shareholders. See, the first entry we have passed, we have redeemed preference shares. Okay, we have redeemed the entire preference shares of 75 crores. Next entry is for buying back 50 lakh equity shares of rupees 10 each at 50 per share. So when we do that calculation, first let us find out how many shares actually we are having. When we refer to the problem, see, it has 25 crore shares, 25 crore share capital, and each share is of 10 rupees. So we can assume that not the company has originally 2.5 CR, CR means crore shares. Okay, so 2.5 crore shares of rupees 10 each makes up a capital of 25 crores. Okay, now how much share we are redeeming? We are redeeming 50 lakh shares. So we are redeeming 0.5 crore shares at rupees 50. So 0.5 crore shares into 50 per share means we will require 25 crore rupees to redeem the entire capital. From this 25 crore, face value of these shares will be 50 lakh shares of rupees 10 each. 50 lakh into 10, that is face value of the shares which are being bought back is 5 crore, and the premium will be 20 crores. This is the breakup of, see, this is the breakup of these 25 crores. Okay, we are paying 25 crores to equity shareholders and buying back their share. From that 25 crores, 5 crore is the face value of the shares. See, face value 50 lakh shares multiplied by 10 rupees. Each share is of 10 rupees. So 50 lakh shares we are buying. 50 lakh shares into 10 will give us a face value of 5 crores, and rest of the 40 rupees. Okay, rest of the 40 rupees, from where these 40 rupees are coming. So these 40 rupees are coming from here. See, we are acquiring the shares at 50 rupees. Okay, 10 rupees share we are acquiring at 50 rupees. So how much premium we are paying? We are paying a premium of 40 rupees per share. For 50 lakh share, the amount comes to 220 crore rupees. Okay, so that is the breakup, face value and premium. Now we will pass the entry for the equity shares being acquired or bought back. Equity share capital account debit. Equity share capital account debit, 50 lakh shares multiplied by rupees 10 per share gives us 5 crores. Premium payable on buyback. Okay, this is the premium amount. How much extra we are paying? We are paying 40 rupees extra for 50 lakh shares. We are paying 40 rupees extra, that is 20 crores. Okay, and we'll charge this to equity shareholders. We are buying back, so we'll charge this to equity share buyback account. Okay, so this is the due entry for buying back the share. We are buying back shares worth rupees 25 crores Okay, the face value of the shares is 5 crores and the premium which is payable to these shareholders is 20 crores. The adjustment will be being equity share capital transferred to equity share buyback account. Next, we will make the payment to these equity shareholders. So the entry for payment will be again same as preference shares. Equity share buyback account will be debited and bank account will be credited for 25 crore rupees. Being payment made to equity shareholders. We are having a reserves and surplus of 300 crores. Of that, 15 crore are of capital reserve, 25 crores are of securities premium account, and 260 are from revenue reserves. So from these reserves we need to transfer certain amount to capital redemption reserve, and also we have made a lot of extra payment. We have made a lot of premium. We have given a lot of premium to the equity shareholders. See, for 5 crore shares, the value of 5 crore shares, we have paid 20 crores as premium. So we need to utilize our securities premium account for paying this premium. Okay, so this 20 crore premium will be coming on from this money. Sorry, not that, this money, securities premium account. Okay, so we'll need to pass an entry for that. So the entry will be as follows: securities premium account will be debited and premium payable on buyback will be credited. Okay, see, first of all let us take a look that whether we can make an entire payment of this from the premium account. We are having 25 crores in securities premium account and we need to adjust 20 crores. So entire 20 crore can be adjusted from securities premium account. So straight away I'll write 20 crores. We will deduct 20 crores and use that 20 crores from the securities payment account to pay the premium payable on buyback. And the narration will give being premium transferred to being premium paid on buyback adjusted from securities premium account. Being premium paid on buyback adjusted from securities premium account. Now we have adjusted the premium. Now just we need to make a reserve for the shares which we have bought back. So how many shares we have bought back? We have bought 75 crores of preference shares and 5 crores of equity share capital. So total we have bought 80 crores of capital. Hence we need to create a reserve for 80 crore rupees. So how will we do that, and from where that amount will be taken? See, in sum it is given that all these payments and all these things have been done from the current assets, and from free reserves we will need to take the money from free reserves and create a separate reserve, capital redemption reserve, and that capital redemption reserve will only be used for issuing new bonus shares by the company. So from where we can utilize that money? We can utilize that money from the free reserves. So what are the free reserves? Capital reserve is not a free reserve. Securities premium, we have already used some money from that, but again we cannot use securities premium account. It's not a free reserve. Revenue reserve is a free reserve, and its value is 260 crore rupees, and we can easily make a capital redemption reserve of 80 crores from this amount. So what we'll do, we'll pass an entry. We will debit revenue reserve account. We will debit it and create a new reserve, capital redemption reserve. Okay, and the amount for that will be 80 crores. 80 crores, how we have arrived? 75 crores for preference shares and 5 crores for equity shares. So 80 crores reserve we will create, and the entry for that will be being creation of CRR, capital redemption reserve, to the extent of the value of equity shares to the extent of value of equity shares and preference shares be bought back. Okay, this is the narration that we have created a CRR to the extent of face value of equity shares and preference shares which have been bought back. So these are all the entries which we will be passing for this particular problem. Let us just make a short recap. Earlier we first of all redeemed the preference shares. For that purpose we passed these two entries. Preference shares, first we transferred the amount of preference share capital to preference shareholders, and then we made payment to preference shareholders. Similarly, we transferred the amount from equity share capital to equity share buyback account, and then made the payment to equity shareholders and bought back our shares. Finally, we adjusted the securities premium account with the premium which we paid on buyback, and we created a capital redemption reserve on the face value of equity shares which we bought back. I hope you understood this sum. Thank you.